Good morning, my name is Brian Johnston. As Andrew had asked me to do a video on limit orders in buying the dip in strong downturning markets due to economic circumstances. As you all know, the present circumstances are very grim. Swiss government is buying up US dollars as fast as it can to support its tourism and also save its bank an economic collapse due to the outstanding CHF Swiss loans taken out in Hungary with 1 million homes in question of defaults, and Poland as well with 100,000. It's a grim situation. Japan is also buying up due to their export trades, US dollars, and in the uncertainty of this market one should be careful, as 95% of people lose money trading the forex. This is a strategy I use in strong downturning economic climates, using limit orders and Boson's lines with a maximum of 3 positions on: 0.01 first position, 0.01 second, and 0.01 third position. In accounts above 5,000 I would use 0.1, and above 50,000 1 full lots. Okay, having said that, first of all, this is a template I think might help you in looking at the buying the first position, and simply I would put a limit order on a buy lot, or I would attempt to buy this at 23.6 level. If the price, which is this is the LSMA blue, goes above that point and this one starts to turn down, which is the US dollar. The US dollar has to have a downturn like this little V starting up, but this has to pass 23.6. It would be lovely if the US dollar had dropped below the 61.8 to show that the US dollar is also starting to move down and the Australian dollar has broken the 23.6. You can notice on the currency the huge buying on the US dollar, it's up, and the rest of the currencies are down. I think a lot of countries will join in and buying the useless paper money, US dollar, with the consequence it's like eating a mushroom that's poison when you're starving. It might stave off the hunger pains, but in the end you'll die anyway. That's my opinion. Okay, how do we do it? So you bought the first position in. Where do you put the second position? Normally you could put it on here. It should be at least in the first and the second position. It should be at least 127 pips, I would say, away from the range, being the previous 10-day. It's the highest range. You're in a full falling market, so it should be about 127 pips. At least it should be at this point here. The Boson's second point is here, so it should be a buy on the second point here. But in a real, but once again, you would need a confirmation that you're still above the 23.6 level, and then you would look at, if it keeps breaking the 23, you could put a buy on here, first position, but it would have been better, of course, if you could have got a buy on here, down here. But we're looking at the first position, 0.1. If you want to do a position averaging on this, using this method, using this position, it's quite a good method. Use the first buy on here, then the second buy should be at least 127.6. I would tend to even go higher until that breaks the 23.6 line. Lower, I would look at putting it, you're not sure anything's going to happen, so you want to buy it at least from this point here that you put your first position on. You want to buy it at a second position at least 127.6. I think in this market the resistance line here is a little bit too close to that point there. This is Bosun's lines. There's your monthly line, weekly line. Here's your monthly line. Not much in it, is it? It might only just go up to the monthly line. So I would say let's do it how I do it. I would be looking at putting a buy on here, which is 107,413. 107,413. The blue is going up, and you're pretty good on that position. I would look for a minimum of 127 as a falling market. 127.6 pips below that, and below that again I would double that pips, so I would go to 240 pips below. You can always raise it up on the market if you're trading on the thing and looking at whether the market has been broken or you're in a falling market. Once again, in this market, limit orders should be watched with your chart. It's important that you look at the charts. Don't rely, in my opinion, on EAs for this type of market. It's a falling market. You should be able to adapt with changing market conditions. So you need these two things to make a buy. One, the US dollar is starting to fall. The Australian dollar is starting to go up, and preferences is the first position to put it on. In this case, it breaks the 23.6 line. I would be putting it on at 1.07615, but if you want to, you could put it on here at 10667 as your first position. Then, as it is a very risky market, I would be looking at putting my first position on at 106. As you see the position, the price there, I would then put the next limit order at 127.6. So just put it at 130 pips away, and the final position at double that price, 260 pips. So at the worst instance, you're only going to have 2 pips on the Australian dollar, 0.2 positions on at any point in a falling market for safety of your account. That is how I would trade it. I'm trading it now. I had one position on at one point, I think it was 1.07 I put it on, 1.07, and I would be still cautious on putting it here. I would be minimum on the second position is lower, because until this starts turning, you could put it on now, but when the dollar hits the top here, starts, and it does a turn, doesn't just keep going, then if it's doing a turn and the Australian dollar is going up, that's a good indication of a second position. But always try and maintain your distance between the first position and the second position in this market, and I would say 130 pips away as your second position, and your third is from that position is at least 130 pips again, and maybe double. As this is a terrible market, and in times of uncertainty, one should not go for greed, should be patient and trade in demo unless you have the money you're prepared to lose. And you are really prepared to lose that money trading, then don't trade live in the Forex in these uncertain times. So there you are, that's from Brian. And any time the reversal could be dramatic, huge reversals, and in volatile times with bank intervention, you always have to look at what's happening now. What is happening now? Don't leave an order on, in particular the second position, until you are wide awake and looking at the market. Hear what I say, don't put the second position on until you're wide awake looking at the market now, and be on the safe side, cautious, keep your pips to the higher side rather than the lower side. Only can you put your pips closer when you get a downturn, and in that case you can put your 23.6 on in a different way using this, looking at this currency and doing the same on the US dollar JPY. So use this template on a US dollar JPY, put your fib on that, and when the fib breaks to 61.8, you have confirmation of at least a downturn, complete trend change, they've stopped buying the US dollar, and an uptrend on the currency that you are trading. Okay, that's all for now. God bless. I think in these times one should use buy the dips, but be very careful, as these are extraordinary times and there could be heading for bigger changes. God bless from Brian.